Do you ever wonder why oil-producing countries would choose to pump more oil, even when prices just suffered their biggest weekly drop in months? Today, we're diving into why OPEC Plus, the group of major oil exporters, is likely to boost its oil output quota in the coming month, and what this could mean for your wallet, the global economy, and the market's next big moves. Stick around, because by the end of this video, you'll understand the logic behind OPEC Plus' latest decision, how it fits into the bigger picture of global energy, and what potential impacts you should watch for as an investor or consumer. Let's get right into it. Last week, crude oil prices took their biggest tumble since June. For anyone who tracks their gas bill, that's a big deal. Normally, a big price drop signals there's too much supply or not enough demand, so you'd expect oil producers to tighten the taps, not open them wider. But OPEC Plus, that's the alliance of the Organization of the Petroleum Exporting Countries plus allies like Russia, seems set to do the opposite. They're about to increase their monthly oil output quota. Why would they do this? Let's break it down. On paper, there's already a supply surplus projected for both this year and next. That means more oil is available than the world actually needs. Classic economics says too much supply pushes prices down. So, if you're an oil producer, you'd normally want to avoid making that worse. Yet, OPEC Plus countries are still planning to hike output. Here's where things get interesting. For OPEC Plus, it's not just about today's prices. It's about long-term strategy, market share, and global influence. By raising their output quotas, they're sending signals to both competitors and markets about their strength, unity, and ability to steer the market, no matter what the headlines say. Let's put this in context. OPEC Plus has been managing oil output quotas since 2016, when they teamed up to stabilize prices after a historic crash. Sometimes they cut production to boost prices. Other times, they open the taps to prevent losing ground to competitors, like U.S. shale producers, who can ramp up quickly if prices are high enough. Right now, the world's oil demand is recovering, but not as quickly as some hoped. Economic uncertainty in China, slower growth in Europe, and fears of recession in the U.S. all weigh on energy use. At the same time, non-OPEC countries, especially the United States, have been pumping more oil than ever. In fact, U.S. crude output hit record levels recently, making America the world's top oil producer. So, if OPEC Plus cuts back too much, they risk losing market share to these non-OPEC rivals. By increasing their quotas, even if only on paper, they're signaling to the market that they're not backing down. They want to keep their slice of the pie as big as possible. But there's another angle. Not all OPEC Plus members can actually meet the higher quotas. Some countries, like Nigeria and Angola, have struggled with underinvestment and operational issues. So, the real-world increase in supply might end up being less than what the quota suggests. That gives OPEC Plus some cover. They look like they're boosting supply, but the physical barrels may not materialize in the market. Now, let's talk about the immediate impact. When OPEC Plus signals more supply, markets can get jittery. Oil prices might dip as traders anticipate more barrels hitting the market. That could mean lower prices at the pump for you and me, at least in the short term. But if demand rebounds or some producers can't deliver on their promises, prices could bounce back quickly. Historically, OPEC's moves have had outsized effects on energy markets. Remember the oil shocks of the 1970s? Or the price wars of the 2010s. While today's market is more diversified, OPEC Plus decisions still ripple across economies, affecting everything from inflation rates to the cost of groceries. Let's not forget the political angle. Some OPEC Plus members rely heavily on oil revenue to fund their governments. Higher output quotas can help them project economic strength, even if actual production doesn't rise much. And with many countries facing budget pressures, the optics matter. Looking ahead, what does all this mean for you as an investor or consumer? If OPEC Plus continues to raise quotas into a surplus, we could see a period of lower, more volatile oil prices. That might be good news for drivers and businesses with high energy costs. But for oil companies and energy stocks, it could mean tougher times, unless they can find ways to cut costs or diversify. Keep an eye on U.S. shale producers too. If prices stay low, some may have to scale back, which could eventually tighten supply and push prices back up. It's a classic boom and bust cycle that's played out many times before. Bottom line, OPEC Plus is playing a long game. By raising output quotas even when prices dip, they're balancing complex priorities: market share, income, and influence. The move may seem counterintuitive, but it's a calculated bet in a fast-changing energy landscape. So, what do you think? Should OPEC Plus keep boosting production, or is it time to tighten the taps? Let me know in the comments below. And if you found this breakdown helpful, don't forget to like this video and subscribe for more clear, no-nonsense takes on the financial news that matters to you. With oil markets, the only thing you can count on is change. The next few months could set the tone for global energy and your next trip to the pump. Stay tuned and stay informed.